How does long-term investment benefit the world? Do wealthy family businesses stabilize global finance? What new challenges do tomorrow's family leaders face? Can rising families in the East learn from old money in the West? Introducing Mr. Vincent Duhamel, head of Asia Lombard ODA.
My seat. Oh. You are all yesterday?
I think we go. Good afternoon, everyone. I'm aware that we're kind of in between the coffee and the rest of the afternoon, and we're supposed to be the entertainment to keep you awake until about 4 o'clock. It's always a bit of a challenge right after lunch, so you might want to have some more coffees, but we do have a very, very good panel group here this afternoon, and especially a topic that is very interesting, very changing, very challenging for a number of them. In my business, we deal with 3 types of clients. The first types are the pension funds, insurance companies that tends to have very clear agenda based on very clear liability streams that they have in the future. The second type tends to be the sovereign wealth funds, central banks, etc., who also have a pretty clear agenda, often is an agenda that is controlled by either politicians or they do have a clear charter of what they're supposed to achieve. And then we have the third type, and those are the family businesses or the family owners or the family offices. They're the family tied with the investments. And for these, it is a different matter. It can be a very challenging, it's always very interesting. But there's a dynamic that exists with these investors that is very different than the others because it's a very much of a people dynamic, a human dynamic. But what we do find, and I'm very close to this because our own firm is 7th generation and we do have a number of family members in there, is that the agenda is always the same. There's one thing that's always the same. There's a common denominator for each and every one of them. It is the fact, the realization that they were born in a privileged situation with a very large burden. And this burden was to ensure that whatever they received, they need to pass it on to the next generation in better shape than what they got. And that is not a small agenda, but that is also how it creates a certain dynamics for those families to invest in the long term and to deal with change. Much better than what a lot of institutional investors can do. To help us on this, we have today a set of different generations of families and geographical dynamics of families. Marcus Wallenberg is the 5th generation. Yesterday we learned 1856 for the bank, the SEB, that I cannot pronounce. I've practiced a number of times. The 5th generation of a very illustrious family based in Europe, one of the oldest families in Europe that have been very active investors and active business managers around the globe. Next speaker is Remy Koch. Mr. Koch is the third generation, a youngster in the generational debate.
Thank you. You made
And-
my afternoon.
Made your afternoon. And is in an environment that has been somewhat challenging to ensure sustainability of family business. An environment like Turkey at the junction between Europe and the Middle East requires obviously some very strong skills in how you manage different agendas. And finally, we have the youngster teenager of the generations, Annie Chan, who has very different views on how to ensure the sustainability of the privilege that was received and to ensure the long-term investing needs of the future generations. So I would like to invite each of the panelists to give some brief introduction, some of their views, and then we'll go through question periods. Marcus?
Thank you. Well, I'm Marcus Wallenberg. I, as said, part of the fifth generation of my family. Started in banking. We're still in banking. But over the years, as the bank progressed in the second half of the 1800s, the bank was very supportive of a number of industrial emerging companies in Sweden, which many of them had run into difficulties, and a lot of the debt was converted into equity, and then the bank was suddenly a major shareholder of a number of large corporations. And the way it functions now is basically that in the early 1900s, there was new legislation in Sweden basically prohibiting banks from owning shares. So you had to divide it basically into, with the same shareholding structure, a holding company for industrial assets, and then the bank on the other side. And at the same time, there was a family foundation started where a lot of the ownership resides. So today, we basically have a situation where the foundation, which gives a substantial amount to research and development in Sweden every year, owns two holding companies, which has in them as participations, usually not a majority, but usually the largest minority shareholdings in large Swedish multinationals such as ABB, Ericsson, Electrolux, etc. So basically, in our system, it's very much based in the ownership is based on the foundation, which in turn is being recycling a lot of the dividends and the income back into Swedish society over time. This gives you a challenge, which means that in order to be able to benefit the society through the foundations, you have to be able to generate substantial amounts of income from the foundations, and that comes basically from good performance of the underlying companies. So there is a big question, of course, on how you in a family try to develop the business over time. To me, that lands very much in the question of being open to change and open to reinventing yourself the whole time, and to really discuss with managements and the boards in these companies that to encourage them to really continue not only to manage their business on a day-to-day basis, but also to reinvent their business, innovate substantially to be able to compete in the long term. And since companies in Sweden, of the large ones, tend to have more than 90% of their sales outside of Sweden, we're a nation of very open and free trade. That means that it's very much a global endeavor on what it's been trying to do. So I think this constant being open to reinventing yourself. Let's take an example, if I may, very short. If you look at, for example, the banking business today, where we have gone through a substantial amount of regulation, in the past 5 years following the financial crisis, and which is, I think, to a large extent, legitimate demand from central bankers and policymakers and politicians, because they would like to have a stable financial system. But that also means that with substantially higher requirements on capital, liquidity, and many, many other measures, I think that banks need to sit down in the boardrooms, in the management, and really think, how should this business look going forward, and being open to that. I think that's part of the challenge. If you look at banking down the line, how can we do this in a different way? How do we make ourselves really long-term beneficial to customers, to shareholders, and to society? This has happened time and time again in businesses that we are involved with over the past 150 years. And I think that will be a very major challenge. And if I look back in the generations past, this is perhaps one of the biggest contributions that my family members have been doing, is really to push for this continuous change to develop the business. I'll stop there.
Thank you. Mr. Kosh?
Yes, our company is about 2 years younger than the Republic of Turkey. It's been founded in Ankara by my grandfather, who had a general store where you can buy cheese and shoelace at the same time. Now we're fourth generation. My father grew up the business. He was alone and he had 2 sisters. I'm the only son. I have 3 sisters. And I don't have any daughters. I have 3 sons who are in the business. We are a Fortune 500 company, and we do about 7 or 8% of GMP in Turkey and pay about 10%, 11% of the taxes paid in Turkey. The company is owned 70% by the family, 10% by the foundation, 10% by the management, and the 10%, last 10% is by the public at large. But we are considered a public company, and 55% of the company is owned by a family company, umbrella company, that only the family members and very few left of the past partner managers, descendants own. And we are in a lot of businesses, but as the competition grows, we have to give more emphasis to the areas where we have an advantage of growth and we can compete. Turkey has gone through 4 stages. First, 100% import, then import and assembly, partly assembly, then partly assembly and partly manufacturing, then full manufacturing, and now it's export-oriented manufacturing. In the old days, we tried to sell what we made. Now we sell what sells and what the export market wants. Family companies, old family company members are not what people usually think they are, namely indulging in high-style life, buying very expensive luxury goods, not caring what the other side of the public thinks of. They drive expensive cars, fly corporate jets, and so on. No, we have, or old family businesses have a social responsibility, and they invest in that, and they know that the decisions that they're going to make ultimately will have an impact in the public, so they're very careful. When you invest, you're investing your own money, so you have to be careful not to lose it. It's not other people's money. And the best thing is, of course, to use professional CEOs in companies, because you cannot dismiss family members. You have to look at it from a top point. And of course, if the CEO doesn't perform, it's very easy to change. But if your son doesn't perform, it's very difficult to get rid of him. The CEOs of family companies don't work or think like the public corporation CEOs. They tend to look more long-term because they're not under the pressure of every quarter to show a profit or to make sure that their market cap is not hurt or is not going down, but tries to keep it up. They have to, before making serious decisions, they have to interact with the family members, which is another dimension in their business, and they think long-term and not short-term. So private family business investments are geared for not a short-term profit turnover, but a long-term investment. And usually they try to be in the same business as they started. Very few of them over the time changes. And statistics show that 18% in America of the companies, family companies, have gone on to the third generation, and 26% is in Europe that managed to hold on to their fortunes third generation. This is all I have to add at this point in time. I think I've said almost everything that I've prepared for, but still, if you have other questions,
But I have some good
very
questions
happy
then.
to answer.
Annie.
Hi, I'm Annie Chen. The booklet introduces me as founder and chairman of RS Group. RS Group is basically my own family office. It manages portfolio that's held in a trust for the benefit of myself and my immediate family. But it's actually a family office housed within a larger family office that my parents created some 15 years ago. Unlike the other two gentlemen who spoke before me, we don't actually have an operating business. The wealth came from my parents. My father co-founded a company with my uncle, but at this point, we're not involved in the management of the company. It's a listed company. And so I kind of come from it from a quite different place than the other two speakers. So RS Group, we're a family office. We basically manage our own portfolio of investments. About 6 years ago, this started about 6 years ago when I had to take responsibility for the assets in my trust. I decided to move my entire portfolio into sustainable investing. And we spent a few years building up the portfolio. We started actually basically along a basic system of doing an asset allocation. We go through a process of figuring out what the liquidity needs are, what my risk appetite is, long-term needs are. So it's a very traditional process with the big difference that we are consciously trying to shift our portfolio into sustainable and responsible investments. So we have investments into funds. In fact, I believe in the portfolio we have the SEB Tracker Fund, along with other funds. And I have a financial advisor who helps me identify products across different asset classes. But one strong criterion is in the selection of managers. We make sure that the managers of these funds have ESG, sustainability, in their DNA. And that it's not just paying lip service. And in fact, in the last few years, we have exited a couple of funds even though we try to invest for a long term, we give them at least a couple of years to perform. But if we feel that through our review exercise that they are not actually following the sustainability mandate, we will exit. A part of our portfolio is aimed at impact investing. By that I mean investments for which the main intention is to create positive social and environmental impact. That's not to say that we disregard the financial performance of these investments. It's just that we view these investments as part of a larger portfolio. We try to generate more financial and liquidity returns out of other parts of the portfolio, but a certain part of the investments we are really looking for positive impact. And out of the liquidity generated and the returns generated, we use the proceeds besides kind of sustaining my personal needs. It's also for grant making, and we call this taking a total portfolio approach, as opposed to managing the investments on the one hand and then only using the returns to make philanthropic grants. The reason that I'm doing this, I guess it really comes down to having kids. I said, this goes back about 6 years ago when I had to take responsibility for these assets, but the journey really started probably way back when my parents set up the family office and started becoming part of the family office management. As a lot of you know, family offices are usually set up to manage the family wealth and investments. And suffice to say that over 15 years, we've gone through a lot in terms of dealing with governance issues, working out, within family dynamics, who's going to do what and how we're going to make decisions. And certainly, we also engage in a lot of collective philanthropy. My parents have a foundation, our generation also has our own foundation. I guess what happened was, all of that happened in the last 15 years kind of led me to where I am today. It boils down to, I said, really my kids, and precisely when I had to take responsibility for investing these assets, I was asking myself, what do I want to leave my kids? And what kind of environment do I want my kids to live in? I think even though we don't have an operating business, I think, and maybe because we don't have an operating business, I felt very much, just the another kind of burden, not the burden of, having to leave a legacy of having a healthy operating business, but a burden of, having wealth that we're lucky to have, but that isn't used to solve the world's problems. The other thing is a concern about the environment. I think in this day and age we live with a lot of dissonance. We are very concerned about the environment, particularly if you live in China. You worry about water, you about food safety, you worry about pollution. We all know that actually our lifestyles contribute to all of these problems that we have to live with day in, day out. But as individuals, we feel that there isn't a whole lot that we can do. And I started asking myself, what can I do? And basically the tools that I have and the resources that I have are a pool of capital, my own time, and also leveraging on my colleagues' time and their expertise as well. And so I made a conscious shift. I couldn't find actually somebody in Hong Kong in any of the banks to help me. So I actually had to hire a financial advisor from Europe all the way from Europe. But he was very knowledgeable, experienced. It took time for us to do it. We're still not there yet. Impact investing is still a relatively new arena. It turns out to be a lot more difficult to do well than people think. But the deeper that we get ourselves into this, the more we feel that that it is needed, and that even though we don't have a lot of examples to follow, we are learning a lot just simply by making the decision to do it. So that's where I am.
Thank you, Annie. And we'll come back because there's a few questions, I think, on that issue that will be interesting, especially in an Asian context, to develop and in the spirit of this conference, of this dialogue today. Marcus, one of the, and there's just no way I could not have asked that question, especially with Ambassador Yang sitting at the table right there. One of the challenge of family businesses such as yours is how do you manage the whole governance of this? Because on one side, we talk about long-term investing, and you do have a long-term agenda as a family. But on the other side, having other shareholders with you participating into this journey, often they will tend to be interested in your performance on the next quarter. And it's bound to bring some conflicts, it's bound to bring some issues. How do you manage these corporate governance issues and problems, the challenge for all the different businesses that you have?
Yeah, but often this discussion comes up about the short term versus the long term, but it's actually both. You know, you can't just only look at the long term and not the short term, and you cannot only look at the short term and forget about the long term. And especially, I think today, with very volatile markets, very volatile economies, you have to have a vision to where you try to go, where you aspire to go with the businesses. But you have to, in these very difficult economic climates, really be ready to manage on a day-to-day basis, a weekly basis, and really calibrate your business model as you go along. The long-term ambition, in my view, does not go in the way of short-term management. What it does make it more difficult is to try to in some way manage your results on a quarterly basis, because that's when it gets really, really difficult. And especially in businesses where you have extremely long development cycles of your product, where you have to innovate, where you have to stay competitive, but you may have development cycles which are very long. I mean, the pharma industry, it takes you 8 or 12 years to come with a new drug to the market. So you can't take a very short-term look on this. If you are in heavy engineering with very high engineering skills, with long development cycles, you have to manage both. You have to be able to put away a substantial amount for research and development. I think most investors with the perspective see that. But it's, of course, it's a short-term, you could say, in many ways, a temptation to perhaps not look at the innovation and the R&D for a long term and thereby increasing short-term profits. But I don't see this as a conflict as long as you try to keep your long-term vision and your aim, where you're trying to go over the cycle, so to speak.
Mr. Koch, you're third generation of Turkish conglomerate with a global footprint, but you have pretty rowdy neighbors around Turkey. Turkey itself has been a very calm kind of environment, very high growth environment, great demographics, but the neighborhood has been a bit active. Do you think being a family business, an environment like this makes a difference to take long-term position, long-term views of it? Would it be different for a publicly traded company? Would they made different investment decisions?
Our neighbors, the Middle East has been shaking, breaking, and difficult, and conflicts and wars and things all the time. So we're used to working in that kind of a climate. We also work in North Africa and the Turkic republics. There's a lot of border trade going on, as you know, Turkey is the only Islamic secular country in the world. So the Middle East business is more dependent on the religious side, whereas we take our decisions independent of the religious thoughts. Therefore, and the Turkish business men at large are used to working in this very slippery climates. Turkey's economy also has gone up and down for many times, and they managed to sustain business, and what is most important is that change. We have to change with the changing conditions, and Turkish businessmen are used to having this kind of inbuilt capability. Of course, we have to follow up the developments very closely, both political and economic in the Middle East, and give judgment and investments and do business in that part of the world accordingly. The more riskier places you go, the better is the profit. The less, if you want 100% security, you go to Switzerland and do business there.
Come to Lombard.
Therefore, we're used to doing business in these different countries, different climates, and different economies.
But
our investors, the people, the funds, the other corporations that buy our shares also think long term. They don't think short term. We do distribute profits, and they're healthy profits, but they think long term when they're investing in our business, because it's a holding company and it's got a lot of companies under the umbrella. So if they buy holding shares, Koç holding shares, they know that there's linear stability there, and it's not up and down as other businesses do. We have this shock absorber of having different companies that can deal with different circumstances. I think, have I been able to answer your question?
I think so.
Good, not bad.
I think so. Annie, one of the things, I think one of the ways that you try to maximize impact and maximize the return, both from a return standpoint, from the impact that you have, and this is relatively new now, in Asia, is something that, from what I read, was called blended value approach. And this is really trying to combine both the investment and philanthropic activities, or the impact that you have with all the investments that you make. Could you try to explain a little bit as to what it means and what it represents? And that, would you think as long-term as Marcus and Rami think?
Yes, we do.
No, I'm talking to Annie.
I'm sorry, I thought you were asking me. No, I thought we'd answered
But you want to answer after you
Please.
Let me just
raise your voice a little.
Oh, sorry. Okay. I make a distinction between when I use the term total portfolio approach versus blended value. Blended value, I really think of it as a lens through which we look at our investments, in the sense that any investment, even if you're thinking that it's a very mainstream investment, it actually produces more than financial return. It's just that as investors, we're used to only tracking the financial performance, and we kind of put to one side the other performance coming out of the company. So, for example, until recently, people probably didn't pay too much attention to your environmental footprint. While there are certainly very socially responsible companies that think about their employees, etc., there are also companies who really are only focused on the bottom line as opposed to the well-being of their employees. In a different day and age, maybe those things didn't matter as much. I think now, with really the reality of all these issues becoming really that much closer, I think blended value is a way of allowing us to really see more holistically what our investments actually achieve and what they produce. So that's what blended value is to me. And when I say a total portfolio approach, it is looking across, the investment, the impact, and also the philanthropy, in the sense that they are all kinds of investments. It's just that for each piece, you're looking for a different combination of returns. So for my more mainstream part of my portfolio, which are really just into global equities funds, fixed income funds, but albeit with the sustainability requirement, they do generate the return and liquidity that we need in order to be financially sustainable. For the more impact-driven part of the portfolio, we're willing to take somewhat higher risk on the financial side, but with a focus on the potential social and environmental benefit that could come out of those activities. And then, of course, for our grant making, there's no financial return to speak of, but they are needed in order to either facilitate some good work that's going on, and also the other thing is we also do try to look across the portfolio to see whether this part, the philanthropic part, can help or have some synergy with some of our investments. So I'll give you one example. Recently, we adopted an investment as part of our investment policy to begin divesting from direct fossil fuel investments into fossil fuel production companies and closely related service companies. We can't do that overnight, and we're not looking to be, take a very purist approach, but we are concerned about climate change. And so, we're looking to reduce our exposure that way. At the same time, we made a philanthropic grant to an NGO to do a piece of research around the potential exposure of fossil fuel as stranded assets in the context of Asian companies. So this is how we actually look for ways to express our values and our beliefs through the investments that we make and through the philanthropic grants that we make.
How do you ensure that you don't fall in love with those businesses? And you've been with this bank for 1856 or 46. When do you take the decision to say, it's been a family business, we have our name all over the place in this bank, pictures of all my grandfathers and this and that. Where do you cut the link to say the banking industry now is not attractive anymore and we're out?
It's too early to tell. The investor, which is one of the holding companies we work with, was the biggest coal trader in Sweden in 1920s. We sold that, actually. It's pretty good, yeah. And there are a number of things that we have left. There are a number of things that we have entered over these years, and I think we'll continue to do that. But I think one of the tricks, we discussed it last night, but I think one of the important things is really to feel passionate about these businesses if you want to be an effective owner over time. If you don't do that, then you will, I think, be perhaps losing the focus that you need to be substantial.
It's a very fine line between being passionate and stupid. I think there's someone in Asia that mentioned that not too long ago. And where do you cut? There's a point of being passionate about the business, but at some point you get blinded by it, or how do you keep that discipline not to be emotional about it?
Exactly, but still, most businesses you can actually redevelop and redirect many of the businesses, and see to that you get yourself into a position that will be sustainable for the future. If you don't, well, then it's difficult to have another generation, of course, if you're not able to continue to develop the business in the way that it will be sustainable and so on. And I think there is an element here of, I just want to go in a little bit to the question of Annie about sustainability, because I think that's one of the key issues that we developed and that we need to discuss in business, because sustainability could be around economic terms. But I also think that sometimes I think we forget that for businesses to be relevant over time, they have to be also sustainable for the environment. At least coming from Sweden, which has very, very high environmental standards, you could say, for example, that there are now so many environmental standards and regulations being put on these businesses, so they will be unattractive over time. But this is, I think, the wrong way to think about it. I think, on the other hand, you should really think, how can you be sure that you develop the businesses in such a way that it will be attractive for consumers from a sustainability point of view over a long period of time? An example of that is, for example, IKEA. IKEA one year, they're the largest producers of catalogs in the whole world. And one year they decided that all paper that they use for printing had to be chlorine-free. And that was a complete shock to the pulp and paper industry. And you can ask yourself, do you give up then? Or do you adapt? It's a huge investment cost. It's a huge way of looking upon it. But actually, the pulp and paper industry adapted. If you don't have the passion at that time being in the pulp and paper industry, you will probably just stand up and leave. But there is probably, you know, if you really think about the businesses and think passionately about what you're trying to do, I think there are a lot of room to maneuver to be, you know, sustainable both economically and to society over time, without being stupid.
Mr. Koshner, in the family, you have 3 sons that are active in the family business. How do you, you know, I'm assuming, you know, a big part of that, there's been a major transfer of the experience that you've developed that came from, you know, your family or your father and grandfather before you. And they also bring new perspective, being of a younger generation. How do you keep that balance and that discipline, the balance between the discipline, the innovation that they're bound to bring in with different views, different experience? Do you have advisors? Do you surround them? How do you keep that going to ensure that they'll do the same thing with the next generation after that?
The more family members are involved in the business, the more difficult it is to give decisions. My sons are not executively involved in the business. We have professionals. We have group presidents. They give us their budgets every year. That has been approved. And they just follow how things are going. I mean, they're closely interested in some groups, my sons, than other groups. So they follow that up very closely. You know, companies are born, they're like people. They grow, they become old, and when the time comes, you have to get rid of them. But the most difficult part of it is that some of the family members are sentimental, nostalgic, and they love a company more than they love other companies, and it's very difficult to get a decision out of them to get rid of the company. And this has been very difficult with us, but we managed some years ago to really shed some leaves and some branches and so on, and so that the basic trunk of the company is strong and alive and active and dynamic and can compete. Decision making is not easy with family companies. You have your board, and you have a family board, and you have other people involved, and you have to be extremely patient, convincing, and give enough reason why some decisions have to be taken. It's not a dictatorship that one thinks. And the more members are involved, it becomes more difficult, and the less members have shares of the company, they're less interested in how the business is going, and they look their dividends, and that interests them no more. So it's very difficult to have a small shareholding member of the company be as much interested as a larger shareholding member of the company. And these are little checks and balances and delicate matters that come to surface when you have to take serious decisions.
How much is the importance of structures around the families, either foundations, trusts, boards of advisors, to help discipline, and I wouldn't say discipline, but to help the family coming to terms of making the choices between the family dynamics or the financial dynamics of the companies and trying to foster this long-term approach? And that question will be for the three, because I think there's three sets of experience here in family dynamics and, looking long-term for the business, the family business.
In our family, we have a family meeting, family group, that meets in the company that owns 51% of the group. And when we get together, good or bad, we take a decision, and everybody must adhere and accept that final decision. So we come out with one word to our managers or to our presidents or to the public at large and so on. We have very valuable members on our board, co-holding board, and our good friend Victor is the last member joining our board from Southeast Asia, that we're very proud, and we're taking his advice. And although he missed out at the last meeting, he connected over telephone, and he still gave his opinion. So we have Americans, we have English, we have Germans, and Mr. Funk. So, of course, these international figures give you a lot of depth, and it's advisable to take their experiences and their knowledge and their know-how. And we try our best to capitalize on that. So it's a lot of internal dynamics that you have to keep at balance to run it properly.
Would Annie or Marcus like to add anything?
Well, I think we're less structured than that. Of course, we have a very clear setting with the rules of the foundations and the companies where we act and so on. But I think we are relatively flexible. Of course, we bring people together and we discuss what are important issues over time. Otherwise, we work quite decentralized through it. And then on the family basis, those of us who are engaged in the business are basically continuously talking to each other. And then that is a very, very important setting. I think a basic rule for us throughout the generations has been the emphasis on the people that are sitting in the boards and or the executives of the companies which are actually operating. Very, very important component of what we do.
What is the, let's say I run a business, I'm in difficulty, I need to do the fundraising, and I have a few investors coming to me. And I have a pension plan from Canada coming in, I have an insurance company from Europe coming in, I have a hedge fund or a private equity fund from the US. What is the benefit of me as a company or as a project to have a family business or a family entity investing in my capital?
Yes, you mean?
The three of you. It's your more portfolio. It's a bit.
You know this business better than we do.
I'm not sure I completely understand your question. Is do families kind of bring in anything?
Well, you compete.
As an investor?
You compete for returns in investments. You have to invest, and it's a very crowded area. There's a lot of people that invest for the long term. You have private equity funds, You have the pension funds. They've been very aggressive on that space. You have the insurance companies. So I'm a billion-dollar company. I'm looking for $250 million. I need to have an investor that is going to bring me something to develop a new project. So what is it that a family business can help me with, or what do they add in terms of value to the investee companies?
So as I said, we're no longer part of an operating business. So I really look at my investments purely as an investor. That said, I think there are people who come knocking on our doors, specifically looking for family office money. I think I would imagine that maybe part of the reason would be some of the networking and the connections that a family can bring. If you come in as an investor, you probably could bring in other similarly situated folks. Sometimes it is about a value alignment, I would say. Maybe less so for these really humongous funds, but there are situations where we have been approached by some fund houses, and they look very specifically, maybe not so much for families as such, but they're looking for investors who have a values alignment with their investment thesis and the way that they approach investing. So we have come across that.
Investment companies invest in our company. We don't invest in theirs. But the individual members of the family with their own wealth go and invest in investment companies.
No, I mean investee companies. So I have a manufacturing company. This time I have a
They buy our shares. Investment companies buy our shares. Yeah. Right. That means they're investing in us.
You investing in Mr. Fong, Li and Fong suddenly needs to have a new investor. They have a big project. They're looking to make an investment. What's better for him, to have a private equity fund investing, or to have a pension fund, or to have a family business? What's the value that you bring to the table to that investment?
Now, that's a difficult question. We invest in individual companies if we have to invest. We don't invest in a fund, such as. But individual funds invest in our companies. They buy shares. Now, individual members of the company, of the family, with their own personal wealth, go and invest through a bank or investment company in funds. And there the question is, how much return are you going to give me? And if that year's record is not so good, they usually give you a 10-year record. Go back 10 years and they say, in 10 years we've done this and we've done that. But they never tell you 10 years ahead what they're going to do, if you know what I mean.
Oh, yes.
Yeah. I have, for your general interest, I have statistics with 40 family companies that they made a study. And if you allow me, I'll tell you shortly, it's not very long. These are companies from Germany, UK, Canada, Australia, South Asia, and the US. And their common denominators are, they're all over 50 years old, and 2/3 are 100 years old. They're all global enterprises. 23 are billionaire families. More than half of them continue to operate the legacy business on which they were founded, namely the main bread and butter businesses they have continued to operate. 7 of them had become publicly traded companies, and 15 of them operate a family investment office rather than a single businesses. It's very interesting statistics. I want to ask Marcus, in the Anglo-Saxon world, the wealth is given to the eldest son. Is that correct, or?
I don't know, actually.
In England, this is true. You correct me if I'm wrong, not to break up the vast lands, they give it to the eldest son whether he's capable or not. Is that true?
In the world of when there were huge estates and so on, I think it was usually passed over to the eldest son.
Eldest son, regardless of his capability.
I think so.
Is that still true today, or?
Not in Sweden. I think that that's gone away now, more and more.
I've known some Swedish businessmen that have left the management control, 51%, to one of their sons. I don't say eldest. Is that true today? Just to make sure that the business is not broken up or handled properly.
I don't know if you can say it's a rule, Rami. I think you see differences from different families and so on. It's been a huge change in past years. Sweden is not a very good example because it's a society that is continuously in development. And the Anglo-Saxon world, I'm not that familiar with on that particular note.
Thank you.
But I think to your question, I believe that we're back into this short-term, long-term thing in my mind. I think family businesses or families who are interested and have spent a long time with businesses, of course, has a quite industrial view on that particular company where it's engaged. At least in my experience, depending if you have a short-term hedge fund or if you have a medium-term private equity, may have a completely different time perspective on what you do. That's a pretty healthy dynamic, in my view, in a company, because management, at least from what I can see, are in that industry. They have a very strong view on what is needed to be done to develop their business in the right way. And when you come in with a financial point of view, you're not always so industrially focused. So I think that if there's something perhaps family companies can do is to bring along some sort of a long-term purpose to what the company is trying to do. Then of course you can always have a debate whether there are financial measures that would distribute more cash or reduce investment into certain areas and stuff like that. But that comes down to a different sort of opinion on how to run the business. And at least in my book, it's quite good to have this debate going and to understand both sides. So I think from that point of view, a long-term shareholder can actually be of quite a bit use to management also when they try to go through these motions.
Thank you. I open the floor for questions. We have approximately 18 minutes to go. Victor, the honor is all yours. The microphone, please.
Thank you. Well, I found the conversation fascinating. I'm getting a lot of free advice and free lessons. One thing I like to raise is this. I've always thought in terms of really making sure that the legacy passed from generation to generation. One of the most important elements, and really in my mind, the unsung heroes, is that there are a lot of very loyal long-term staff in family companies that very often provide the changes, generational change. And I don't think we focus enough on them and their role. I tried to allude to this a little bit last night in a conversation that we had, Marcus. I think the idea of nurturing a really committed, long-term, loyal staff, sometimes they even are with the family, throughout several generations themselves. I think it's crucial to the whole long-term legacy and development of the multi-generational family enterprise. And we don't really focus on that. And I'm just wondering, how do you actually keep these managers, how do you nurture them? How do you keep them really committed and loyal? They need to identify, and to your point, with some of the values and the long-term objectives of the family. And in my mind, they're very different breed from the ones that actually, shall we say, sort of celebrity CEOs of public companies. They're a very different breed of people. And I'm just thinking how one might focus on that and think about, you know, how we actually attract people like that and nurture them across generations. I frankly look at each of your enterprises and others. There's always a group of people, in my mind, that's really providing the infrastructure and the glue across generations in these successful multi-generational enterprises. I just wonder whether the panel might comment on that and maybe share some of your secrets with us.
Would you like to?
Why don't we ask Annie? No. Yes. So I think that you're absolutely right in focusing on a number of extremely capable and very loyal persons who, you know, in the case of my family, have been working for generations with us. And that is, in my view, a huge part of the reason why we're still in business. So I think that is a very important thing. I guess that for many of those managers, it's not only a financial measure, it's also a matter of if they believe in the concept and if they have a passion for the business they're working with, and that they believe in the basic concept of what you're trying to develop for the business long term. I tend to see that is the most important factor for them to stay with us as a family, that they think that we're striving to do the right thing. God knows you make mistakes the whole time, but that's part of life. But I think the ambition there, if there is a congruence in ambition and values and aim and objectives, I think that is an important factor to glue the personal relationships together.
Would you have a incentive scheme or other ways to think that they're part of the extended family?
We don't, but...
Yeah, okay.
We have a coach culture in the family, and we bring managers within the company. The managers we got from the outside have never been able to fit in and work together with the coach culture related managers. Of course, we give them very generous bonuses. We are very much interested in their family affairs. We are interested in their health care, and we're interested in their children's situation. And we have a lot of old managers who are children, relatives are still working with us in the company. To secure this, we hire 100 or 150 youngsters every year to the company, and 1/3 leave after the first year. Then you have half of them leave after 5 years, but the ones that stay forever. So if you bring the managers up from within, they're more tied to the family, tied to the company, and they consider, like the Japanese style, forever. They consider it's their home, it's their own business, and it's the way they would run their own money, that they would run our money, our interests, and our corporation. There are two kinds of managers. One is they're more for the corporation than the family. And there are others who are more for the family than the corporation. And sometimes these two don't see eye to eye. So this is another delicate matter that has to be dealt with. Family would like to have more dividends distributed, for example. This is an example. And the manager or the chief executive would like to keep everything within the company to grow it, and so he has better profits and better remuneration and dividends. But it works, but we believe in our own culture, cultivated and the managers coming from within than from the outside.
I think
if I may, that's exactly the point. I think I was thinking that you know, in building a multi-generational enterprise, markets like yours and Ratmin like yours, you know, sometimes you focus obviously on the family and the family members, but I think that's only a part of the issue.
Yeah.
It's really this whole infrastructure, I call it, you know, the loyal long-term staff members and the system in which you cultivate them is going to be a great part of the longevity. And how you build that into an ecosystem that's long-lasting is absolutely key. It's not just because you have some brilliant sons or, you know, or something like that. It's partly that, and then also having the right rules, but also having the right infrastructure and the support and the human systems that actually nurture these. And that's part of it. Some people call it culture. Okay, I think it's a little more than culture.
The downside to that is that if they become a family member, extended family and so on, then you cannot dismiss them. That's the downside. But usually it works. It usually works.
we have another question on the left here. Mark.
I'm Mark from Asia Business Council. We're fortunate enough to have Marcus as one of our members, so it's very nice to hear again about the Wallenberg story. My question's for Annie, though. Thanks very much. Great presentation. I particularly like the distinction between sustainable investing, impact investing, and grant making. But two, I think, fairly simple questions. How do you define sustainability? We've talked about it a lot, but how do you define it? And how do you distinguish between impact investing and sustainability in terms of financial returns or long-term, or is there any kind of blurring or overlap?
Actually, I ask myself, our team asks ourselves, you know, what do we mean by sustainability? I think, you know, in terms of our fund investments, which are kind of the more mainstream vehicles, we do rely a lot on the knowledge and expertise of our financial advisor. You're clearly, you know, familiar with ESG. So those are, it's a shorthand way, right, of explaining what are some of the questions and issues that managers ought to be focusing on when they select companies. But I'm sure it's a lot more nuanced than that, depending on, you know, what industry you're in. You'd be asking a different set of questions. We can't really dig that deep. So we rely on our choice of managers to be knowledgeable about what kinds of questions they are asking of their portfolio companies in these regards. We haven't quite figured out whether we are going to kind of proactively create a portfolio that has certain weightings that are in line with our sustainability agenda. For example, do we want to overweight on clean energy or renewables or whatnot? Because, you know, once you get there, it takes some special expertise to know how to analyze, you know, those industries and the trends, et cetera, in a way that doesn't unnecessarily compromise your financial return. A question that I do get asked a lot is you know, the trade-off question. You know, by integrating sustainability requirements into our portfolio and impact questions, are we giving up on our financial returns? You know, the way I think about it is that that's really not the question. I think the question is really you're, meaning the investor, being clear and honest about what you're looking to get from your investments. So if all you want is financial return, everything else comes second, there's a way of investing. But if you say, no, there are other things that are important to me, whether it's an environmental benefit or a social benefit, whether it's affordable housing, lessening pollution or whatnot, then you look at that particular investment opportunity and say, well, what am I after? If it means that at that particular point in time, this particular investment is not likely to give me market rate returns, but it has a strong potential or immediate impact on what's important to me in terms of the environment or a particular social issue, and you are clear about what that investment is likely to generate and meeting your requirements, then you make a decision on that basis. And I think the beauty of us taking a portfolio approach as opposed to an individual investment analysis is that we can, in a way, we can do the trade-off on a portfolio level rather than focusing on individual investments. We know that some of the higher risk investments may or may not pan out. But we are making a statement, but a thoughtful, after a thoughtful process of doing, we do due diligence, we monitor, we try not to make stupid investments, although we've made some, and I'll confess to that, but we learn from that. So there's a thoughtful process behind, our choices. And I think all I can say is that, I'm conscious about why we include that investment in our portfolio and how that investment is likely to impact our total performance. I don't know if that answers your question. I mean, that's why I say it gets a little complicated.
Just a follow-up would be, when you decide not to invest, so what's the process you went through recently to decide that you will slowly divest from fossil fuel-related things? And you've been doing this sort of sustainability investment for a while, and then something changed, I guess.
I think it's we call it dialing in. I think when I first started 5 or 6 years ago, it was the words sustainable and responsible that appealed to me. I can't say that that I completely understood what that process involved. That's why I had to go out and find somebody who's knowledgeable about that to actually help me with the process. I learned, over these years that it's really not easy work. It's not as if I just pick the right names and that'll lead me to the right investments. It's like any investment process. It is thoughtful. It takes time. It takes patience. So, we don't make our investments lightly. So there's a screening process. We came to a decision about divesting from fossil fuel partly on the basis of Carbon Tracker's analysis about stranded assets, partly because, living in Hong Kong, I think air pollution is an issue that, is very real. The price of energy is, well, maybe not energy, but gas certainly, is very real. And I think, it's something that really does hang over my personal head a lot, is this concern about climate change. And I can't think of any other better way of expressing my values and my beliefs other than to say, well, this is how I act on it. Now, I have to confess that, we try to do that through our portfolio. I haven't quite figured out how to do it personally. You know, it's very difficult, actually, you know, to act on towards a more frugal lifestyle, to make that in alignment with, you know, all these values that I try to express through my investing.
Especially in Hong Kong, unless you want to row to San Francisco, you're going to have a carbon footprint at some point with this. On this, we have exactly 26 seconds to go, and I was under very strict instructions that this panel had to finish at 4 o'clock, but I really appreciate this was a very interesting one. I think we've covered a lot of the grounds here on this panel, both from a development standpoint, geographical standpoint, and generational standpoint. So thank you very much for your time. Thank you. Thanks.
Ladies and gentlemen, we will now take a 30-minute break. A kind reminder that Mr. Pascal Lamy will now host a book signing session at the Cambridge University Press counter located in the foyer. The next session will begin at 4:30. Thank you and enjoy the break.